Well, you probably heard that Warren Buffett, one of the, greatest investors of all time, is now sitting on an incredible amount of cash. I mean, it's a record for Buffett, and that's really saying something. Berkshire Hathaway currently has over $340 billion sitting on the sidelines. That's more than most countries have in their central bank reserves. And naturally, people are kind of wondering, well, Warren, what's going on here? Is Buffett, who's in his 90s, gotten out of touch with the market? Or is the Oracle of Omaha quietly preparing for something that Wall Street isn't seeing? What do you say we take a deeper look at why Buffett's hoarding cash and what it actually tells us about the current market and what regular investors just like you and me, who may not have $340 billion, can learn from that? Okay, to explain the significance of Buffett's cash hoard, have a look at some of these statistics. Back in 2018, Berkshire was holding about $110 billion in cash. By 2020, it had grown to $137 billion, and now, as of this year, it's more than $340 billion, and that means 1/3 of Berkshire's total market value is just sitting there in cash, uninvested. It is invested in short-term U.S. Treasury bonds. Now, this has led a lot of people in the investing community to speculate that Buffett's preparing for a massive buying opportunity. I mean, why else would he be shoring up the whole war chest? Well, the interesting thing is that at a recent Berkshire meeting, Buffett himself actually addressed this exact question, and the answer definitely wasn't what everyone was expecting to hear.
I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. We only swing at pitches we like, and it isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
Now that clip really captures Buffett's entire investment philosophy. Buffett doesn't invest just because he has cash to spend. He waits for what he calls a fat pitch. And that's a rare opportunity that's right in his circle of competence with a clear margin of safety, a pitch that he can swing hard at when the odds are heavily in his favor. In baseball terms, he's not trying to hit every pitch that comes his way. He's just standing at the plate with infinite patience, letting thousands of pitches go by until he sees the one that's perfect. Now, this is why Berkshire's cash just keeps stacking up. Buffett and Munger have always believed that doing nothing is perfectly acceptable if there are no compelling opportunities. As Munger once said, the big money's not in the buying or the selling, but in the waiting. And right now, Buffett is waiting. But does this mean he's potentially seeing a crash coming? No, not necessarily, because we also have to remember that Buffett suffers a very significant handicap these days that the rest of us don't, and that handicap is size. Berkshire Hathaway has become so enormous that in a bull market like this one, it's almost impossible for Warren to find investments that actually move the needle anymore. Buffett's always said that he's only interested in ideas that make a meaningful difference to Berkshire's overall results. And when your company's worth more than $1 trillion with $350 billion on the sidelines, meaningful means deploying tens of billions at a time. And that's a huge problem because Buffett also has another self-imposed rule. He doesn't like to own more than 10% of any one public company. So for him to invest, let's say just $10 billion of that $350 billion, the company already needs to have a market cap of at least $100 billion or he'll be over the 10% limit. And there are only a few dozen businesses in the entire world that could even qualify. Then, of course, it also has to be a business that Buffett understands, something within a circle of competence. And remember, Buffett famously avoids anything he can't wrap his head around. And unfortunately for him, with many of the world's largest companies having complex technology, this limits his selection even further. And finally, the last hurdle is it has to be attractively priced, offering him that crucial margin of safety, which is increasingly difficult to find, if not impossible, in today's market conditions. So when you add up those three filters together, the size, circle of competence, the price, there just usually aren't any opportunities that fit. And Buffett knows this. He's actually written in a recent shareholder letter that size did Berkshire in. And overall, they have no possibility of eye-popping performance going forward. And so, Buffett's cash pile just keeps growing. It's not a prediction of a crash. It's just a reflection of how few fat pitches there are for him to be able to swing at. But what does that mean for you and me, the little guys, right? We don't have a size problem. In fact, we can be incredibly nimble in the market, and that gives us a big advantage. And I'm talking size when we're doing something like under 300 million. While Berkshire is forced to look at Apples, Cokes, Chevrons of the world, we can search across the entire market from small caps to mid caps, to lesser known businesses that are still under the radar. And that's where Rule 1 style investing really shines, you guys. For individual investors, Rule 1 is amazing because even when the broader market feels expensive, there are often pockets of opportunity hiding underneath the surface. You just have to be willing to look a little bit. Now, the key isn't to change the strategy or chase riskier investments. It's just to stay disciplined, stay rational, slowly expand your circle of competence, and keep turning over more stones until you find that wonderful business trading at a reasonable price. As Buffett himself often says, the opportunities come infrequently. When it rains gold, get out a bucket, not a thimble. Our job as small investors is to be ready for that gold to fall out of the sky. And the way we do that is by knowing what to look for, by staying patient until it comes. Because unlike Buffett, we don't need billions to move the needle. We just need one or two great ideas and the discipline to wait for them. And here's the good news. Even those more expensive market conditions like now, there's still opportunities. I'd say over the past 7 years or so, with all the excitement around technology, AI, a historic flood of trillions of new dollars into the economy, the markets have become quite expensive. But despite that, my team and I of portfolio managers have still been able to at least find one or two truly great companies every year that met our criteria. Now, these are businesses we understand. They've got strong moats, they've got honest, capable management, and a clear margin of safety. We're buying them on sale, and those handful of opportunities have been enough to drive really strong long-term results. Now take Chipotle Mexican Grill, Sprouts Farmers Market, Netflix as a few notable examples. All of them went on sale, and all of them saw their stock prices just rocket up many times our investment. So you don't need to be out there finding 10 or 15 stocks to buy every year. You really only need a few opportunities every decade to seriously compound your wealth. And that's what patient looks like in practice. It's not sitting on your hands forever, but it's also not forcing a decision when nothing looks attractive. It's spending your time learning, researching, refining your watch list so that when the right opportunity does come along, you are ready to swing hard. And that's where Buffett's principles still guide us perfectly. We call these principles the 4 M's. You guys have heard of this. Meaning, moat, management, margin of safety. Meaning is, really simply, you understand the business. You understand what it means. The moat, protection against competition. Management, you want to have them have talent and integrity. And a margin of safety, you want it on sale. If you stay focused on these 4 areas and keep expanding your circle of competence and stay rational when everybody else is emotional, you'll continue to find opportunities that others overlook. Because the real lesson here isn't about waiting for a crash. It's about being ready when the next opportunity for you arrives. And with that said, before I sign off, if this sounds like something you guys would be interested in learning more about, man, I would love to invite you to join me and my amazing team of Rule 1 coaches at an upcoming 3-day virtual investing workshop. I teach for 3 days. We do it entirely online. We go through everything from 4M investing to incorporating stock options into your investing strategy. And we've taught now about 25,000 people around the world. We're not like those workshops where they try to upsell you all the way through the weekend and never teach you anything. We just teach. There's absolutely no selling, zero. The stats don't lie. Our participants love this workshop. We have net promoter scores that beat even the likes of Harvard and Yale. So if you'd like to get serious and really take charge of your financial future, please come and join us at the next event. The details for that can be found in the description, in the pinned comment, and also by scanning the QR code on the screen. But with that said, thanks for watching. Now go play.